Have you ever felt like you're riding a financial roller coaster in the world of cryptocurrencies? One moment, you're on cloud 9 with soaring profits, and the next one, you're plunging into the depths of uncertainty faster than you can even say the word Bitcoin. Well, the volatile crypto market can both attract and deter investors. It attracts them by offering an opportunity for them to capitalize on high-risk, high-reward scenarios with the possibility of significant returns within a short period. However, this volatility can deter investors due to the inherent risk of losing a substantial portion of their investment within the blink of an eye. But today, we have some good news for you. Amid all this chaos lies a powerful weapon: stablecoins. Stablecoins have emerged as the anchor in the rowdy sea of cryptocurrencies with innovative reliability of traditional financial mechanisms. Asking yourself how? Make sure you stick around because we're going to uncover the secrets of stablecoins, their different types, how they work, and the risks against the rewards, as well as discover why they are the ultimate solution to exploring the unpredictable crypto space. Without further ado, let's jump right in. Stablecoins are cryptocurrencies whose value is pegged or tied to the value of another currency or a commodity. Before we even go further, let's define pegging. A currency peg is simply a policy where a national government sets a specific fixed exchange rate for its currency with foreign currencies. These reduce uncertainty, promote trade, as well as boost the economy's stability. It bears mentioning that in the past, the dollar was pegged to the value of gold. People could exchange their dollars for gold at a fixed rate in the bank, effectively anchoring the value of the currency to a tangible asset. Back to the stablecoins now. Stablecoins aim to provide an alternative to the high volatility of popular cryptocurrencies like Bitcoin, BTC, which has made crypto investments less suitable for common transactions. At their core, stablecoins try to offer the best of both worlds: transparency, efficiency, and security of blockchain technology. But how do they achieve this balance? They ensure their value is pegged to more stable assets, ensuring that for every stablecoin acquired, there is an equivalent asset in reserve like a US dollar, euro, or even gold. This mechanism shields users and investors who are seeking stability in the digital asset space. Speaking of stability, let's look at how stablecoins work, because it's not by chance, but by design. To have a clear understanding, we'll look at the 4 different types of stablecoins based on the mechanisms they use to stabilize their value. The first one is Fiat-Collateralized Stablecoins. These are stablecoins that maintain a reserve of a fiat currency, like the US dollar, as collateral to ensure the value of the stablecoin. Note that the majority of fiat-collateralized stablecoins have reserves of US dollars. These reserves are maintained and regularly audited by the independent custodians. Some of the most common fiat-backed stablecoins include USDC, USDT, GUSD, BUSD, and PAX. The second one is Commodity-Collateralized Stablecoins. These are stablecoins that are pegged to tangible assets like gold, silver, or crude oil. This makes them attractive for hedging against fiat inflation or investing in commodities digitally. Some of their popular examples include Pax Gold, PAXG, and Tether Gold, XAUT. The third one is Crypto-Collateralized Stablecoins. These stablecoins are backed by other crypto assets. Yes, you heard that right. But you may ask, how can a volatile cryptocurrency back another? Well, since these reserve cryptocurrencies may also be prone to high crypto volatility, their stablecoins are over-collateralized. This means that the value of cryptocurrency held in reserves is more than the value of the stablecoins issued to the investors or users. For example, a cryptocurrency worth $4 million can be held at a reserve to issue $2 million in a crypto-backed stablecoin. This ensures the reserve cryptocurrency against a 50% decline in its price. A good example of a crypto-backed stablecoin is MakerDAO's DAI, and Reserve Rights, RSV. DAI is pegged to the US dollar, but it's backed by Ethereum, ETH, and other cryptocurrencies. The fourth type is algorithmic stablecoins. These are stablecoins that may or may not hold reserve assets as collateral. Surprised? I guess yes. Now, as the name suggests, these stablecoins have a strategic mechanism of keeping their value stable by regulating or controlling their supply and demand through a computer program that runs a preset formula. They aim to maintain their peg through smart contracts instead of relying on reserves. The algorithmic stablecoin strategy is similar to that of central banks, which do not rely on reserve assets to stabilize their currency value. However, central banks like the US Federal Reserve publicly set monetary policy based on established parameters, enhancing policy credibility due to their status as legal tender issuers. On the contrary, algorithmic stablecoin issuers lack such advantages during crisis, as they cannot rely on established credibility or public policy mechanisms. Some of the popular algorithmic stablecoins include Frax, USDD, and Athena USD. For instance, the Terra USD UST algorithmic stablecoin lost over 60% of its value on May 11, 2022, breaking its peg to the US dollar as the associated Luna token that used to peg Terra plummeted by over 80% overnight. Now that we have a clear understanding of what are stablecoins and how their different types work, let's look at why stablecoins are the best weapon against the crypto chaos. We all know that Bitcoin remains the most popular and dominant cryptocurrency. However, it suffers from high volatility in its price or exchange rate. For instance, in March 2022, its price rallied from just under $5,000 to over $63,000 in April 2021, only to nosedive by almost 50% over the next 2 months. Such wild swings, often exceeding 10% in mere hours, turn simple purchases into risky gambles for both buyers and sellers. Imagine paying 10,000 bitcoins for a couple of pizzas. Ridiculous, right? Let's rewind a bit. You'll agree that all this volatility can be great for traders, but can also turn routine transactions like purchases into risky speculation for the buyer and seller, right? Now, investors holding their cryptocurrencies for long-term price gains will not like the idea of becoming famous for paying 10,000 bitcoins for just 2 pizzas. Besides, no merchant would want to end up with a loss if the price of a cryptocurrency they get paid in takes a downturn. Therefore, for a cryptocurrency that is not a legal tender to serve as a medium of exchange, it must remain relatively stable to assure the users that it will retain its purchasing power. That's where stablecoins come in, by addressing all these problems. With that said, let's look at some of the advantages. As we have already mentioned, even the price of prominent and most stable cryptocurrencies like Bitcoin can also drop by 80% or even more. It's also common for more obscure altcoins to lose 99% of their value, or even disappear completely. On the other hand, stablecoins have their value pegged, preventing such fluctuations. The second advantage is that the concept of stablecoins is easy to understand for beginners, and they can use them to manage their portfolios, rather than navigating the unpredictable nature of more volatile coins. The third one is that they enhance DeFi growth. The majority of the platforms and services in the DeFi space rely on stablecoins. They offer mouth-watering lending, borrowing, and yield farming stablecoin rates. These rates usually have much higher APY than what traditional banking systems can provide. Please watch this video to understand what is APY and yield farming. The other one is security and transparency. Unlike centralized fiat currencies which have centralized governing authorities, stablecoins offer secure and transparent transactions. Did I just say secure and transparent? Yes, I did. But why? Stablecoins are secure because they are launched on a blockchain network. On transparency, you all know that in a public blockchain, everyone can check the transactions on the network. This is unlike in traditional finance where you can't see the process of printing the dollars. Besides, Transferring stablecoins between users is usually faster and cheaper than when you're using traditional banking systems, regardless of borders and location. And guess what? The cross-border transaction can be done anytime and any season. It is 24/7 and 365 days a year. That's cool, right? However, stablecoins are not without a couple of drawbacks. One of them is proof of reserve. Although the majority of stablecoin providers claim that they have fully backed reserves, we can't clearly check if the stablecoins are correctly collateralized. Besides, even the auditing bodies can be compromised, which means there can be trust issues. The other one is regulatory risks. As more stablecoins continue to evolve to become fiat currencies alternatives, the more they will be targeted by governments and regulatory authorities. This might enforce stablecoin bills, rules, and regulations that could have an impact on the functionality of stablecoins. Then we have over-collateralization. As we have discussed earlier, crypto-backed stablecoins need to be over-collateralized to counter the volatility of cryptocurrencies. This type of stablecoins results in more assets being locked up than what is required, which is not efficient and can affect the entire market. We also have algorithmic uncertainty. Although algorithmic stablecoins can be a great solution in theory, practicals show that their mechanisms can be unstable in extreme market conditions. This shows that there's still more work to be done on perfecting algorithmic stablecoins, but let's wait and see what it has in store for us in the future. Speaking of the future, stablecoins seem to have a promising future. As the world continues to be more digitally oriented, stablecoins might become the preferred method of daily transactions for many users. But what is your opinion on that? Comment down below. I'd be eager to read your opinion. If you are curious to find more, then make sure to click on one of the videos you see on the screen. And with that, we come to the end of this video. If you enjoyed the video, then please like it, subscribe, and don't forget to leave a comment in the comment section.